Today we have our friends and partners at T. Rowe Price hosting the call to share their insights on DC system successes and how you, as a retirement plan advisor, can incorporate these actionable insights into your pitch to differentiate your own value proposition. So today we have Michael Davis, Head of Global Retirement Strategy, and Michael Doshier, Global Retirement Strategist at T. Rowe Price, hosting the call today. So we'll pass it over to you.
Great. Thank you, Leah. You can just refer to us as MD squared at this point. So thank you for your time. Thank you for your trust that you place in us. T. Rowe Price couldn't be more honored to be here today and to be in a strategic partnership relationship with RPAG. I'm delighted to serve more as the moderator today. Michael Davis will be more of our technical expert. We're really excited about talking about this. The way we've started to refer to this internally at T. Rowe Price is, let's defend the DC system without getting defensive, right? Because as many of us have seen, there's been a lot of attacks on the DC system of late. And what we want to do is better position you so that you can talk about the advancements that have happened in retirement security nationwide, but also recognize where the challenges still lie and be some recognition of what we need to do to fix those. So let me talk a little bit about who Michael Davis is to my left. I'm one of our global retirement strategists. I work on Michael's team. Michael is our global head of retirement strategy. He's worked in several senior leadership roles around the industry, but most notably, I want to point out, especially for conversations that are policy-centric like this one, that he also served as the Deputy Assistant Secretary of Labor for the U.S. Department of Labor. So very excited about the credentials he brings on that front. Before we jump into the content, I'd be remiss if we didn't talk a little bit about T. Rowe Price. I think hopefully most of you know us. We've been around since 1937. We're one of the largest asset management firms in the industry. We've got over 1.5 trillion in AUM. We are the single largest manager of active target date assets in the industry. We're very proud of that. We've crossed over the 20-year celebration with our track record in target date funds. So very exciting kind of center of the universe for us. I also want to call out specifically in the thanking of the partnership, a couple of things. One, your use of the new CIT solution for RPAG members. It is the Great Gray Trust Retirement Date Trust, a mouthful for sure. This is the only fully active single manager record-keeping agnostic target date solution available for RPAG members. We're very excited about that. And I also want to thank you for using T. Rowe Price Retirement Plan Services through your instant quote system or RFP Express. So with the commercial out of the way, let's dive in. All right. So Michael, let's start with giving people some context about what we're up to at T. Rowe Price broadly and what you and the new Global Retirement Strategy team are up to specifically, especially with the flavor toward public policy and the things that we're active in.
That's excellent. Well, first of all, I just want to say it's just such a joy and delight to be with all of you today, and to you as well, MD, the other MD, as we say here. We're both MD. But it's just wonderful to have these kinds of conversations. And to your question, I think there's a lot to be excited about around retirement at T. Rowe Price. We are a retirement leader, and that is part of the way we want to be more branded externally. We have done a lot to sort of support that thesis, but it really derives from the fact that, first of all, more than 2/3 of our assets are retirement, as you know, over $1 trillion of our assets. That is a very significant proportion of our overall AUM, which means that we get a lot of attention from our management committee and is really a lot of the way we think of who we are as a firm. In addition to that, we have a record-keeping subsidiary that record keeps for over 2.3 million participants. You talked about our leadership in target date. We have a lot of touch points around retirement with individuals, with plan sponsors, with intermediaries. And the question that I think people should ask is, what does it matter? As a client, what does it matter for me? And what I would say, the value proposition for you all is the research, the insights that we derive from not only the interactions we have in the US around retirement, but also around the world, and our ability to package those insights in a way that's usable for you, that allows you to be very sort of conversant in markets around retirement. We want to be able to be that partner for you. And we've had a number of examples of that. One of the more recent is our 5-dimensional framework, which as you know, Michael, is a patent pending framework that we've developed in conjunction with the multi-asset team based on 4 years of their research to help intermediaries, plan sponsors navigate all the myriad of retirement income products that are out there and match those products with the preference profile that they have, be it a plan sponsor or another pool of participants, but being able to match sort of product with the solution. We think that you need to meet clients where they are rather. And I think what allows us to do that is all the insights that we get from across our retirement franchise. I'll also just mention from a policy standpoint, the firm did register as a lobbyist this year. That allows us to spend more unlimited time on the Hill, both with legislators and their staffs and with the regulatory divisions, Treasury, the Labor Department, and be a lot more conversant on areas that we want to be supportive of and advocate for. And we'll talk about that, I know, later in the conversation, but there are a lot of things that we're really excited about regarding those conversations.
Well, I will reiterate the 5D framework that Michael expressed some enthusiasm for. You guys will actually see that. It's going to be on stage at your national conference this summer. So look forward to sharing that in more detail with you at that time. All right, Michael. So those of us that are policy geeks, I'm pointing to my 50-year ERISA anniversary pin that we had made. It is the 50th anniversary, right? As of Labor Day, ERISA is 50 years old. We've seen advances too numerous to mention, but we're going to recount a lot of them today. And we also see that there's been a lot of key milestones that have been achieved over the development of the U.S. retirement system workplace. You want to talk about those a little bit? We'll get you most excited.
Well, I'm excited about these pins. So we actually have these lapel pins. We're building into. There's a big symposium happening here in Washington in September to celebrate the 50-year anniversary of ERISA. I think everybody knows what the acronym stands for, but I like to say it just to make sure. The Employee Retirement Income Security Act of 1974. We're really passionate about it. As some people know, even my license plate, I have elements of ERISA in my license plate, but we live and breathe this stuff here, and we really do get excited about it. This is the single most important piece of retirement legislation that was ever passed in the United States. And what it provided for is things that we now take for granted. So one, just the idea that you would have to keep retirement savings in a separate trust, separate and apart from corporate assets. Prior to that, if a company went bankrupt, often they would take the retirement plan with them. Now, because you have to hold these assets in trust, those assets are protected. Really key development. Also, vesting standards. Before ERISA, it wasn't always clear what your path was as a worker to get access to that pool of benefits. With vesting standards that are provided for by the government, there are limits as to how long you have to work before you get access to those benefits. Really, really important. Also, the role of a fiduciary. We talk a lot about what it means to be a fiduciary. You advise, you're a fiduciary. And as you know, you are sort of prescribed by law to act solely in the best interest of those who are receiving the advice. So these are really sort of seminal concepts in retirement. They also are concepts that get translated not only in the US, but around the world. But it did a lot. The 401k system started in 1978. So those provisions came into the code that year. And since then, you have seen dramatic growth in the retirement asset pool in the United States. So as of 2023, there are over $38 trillion of retirement assets overall. That's up from 11 trillion in the year 2000. DC plans and IRA plans have become the most dominant delivery vehicle for retirement assets in the United States. Again, as of 2023, there were over $24 trillion in DC and IRA plans at the end of that year versus only $3.2 trillion in public sector plans. We can also now say that retirement savers are no longer subject to corporate bankruptcies, and the vesting standards and fiduciary protections really are the envy of the world. And I can tell you that because I've had conversations with other regulators in other countries, and I can't say that we necessarily did everything right in the US, but a lot of these core elementary principles they are really impressed with, and a lot of them do want to replicate over time.
That's great. I mean, those numbers just are mind-boggling, right? I mean, 32 trillion, 38 trillion, 24 trillion in 20 years' time, right? A little more than.
Big numbers.
It is a big number. And I do think we lose sight of that sometimes because we're in the weeds in this business. All right. So I mentioned this earlier. It seems like there's an elevated level of attacks on the weaknesses in the system, mostly from academia, right? You want to talk a little bit about where that's coming from and your thoughts on it?
Yeah, so we know a lot of these critics personally, and they're not bad people. And I think at the end of the day, they're passionate about the retirement system. They want to make sure it's working for all. And we think there's room for debate. We just think that they're not telling the whole story. And so if you look at the facts, and so I just go through a few points, just first starting with coverage. So according to Department of Labor data, there were 115 million workers in the United States that were covered by DC plans versus only 32 million workers that were covered by defined benefit plans. At its peak, defined benefit plans covered a maximum of 39% of employees in the country. DC plans cover more than 50% of workers in the United States. I think a lot of times when the story is told around DC and some of the challenges, it almost presents a panacea in terms of what DB did. DB never covered 100% of workers, and never did. And a lot of it was because of these vesting standards, that a lot of companies just had these really long vesting standards, took you a really long time to earn enough time at that company to be even eligible to get those benefits. So again, so I just want to paint a more realistic picture. The other thing I would say is that ICI research has shown that after we account for taxes, the typical retiree replaced more than 90%, 90% of their spendable income. Now that's done through a combination of Social Security and DC savings and perhaps other savings. But at the end of the day, a lot of times what doesn't get discussed is the role of Social Security and the very important role it has, particularly in giving income replacement for lower wage workers. I also just want to make a couple of points about the middle class. The DC system has just created great benefits for the middle class. So according to data from the Security of Consumer Finances, stock ownership for middle income families has more than doubled from 1989 to 2022, up from 28.9% to over 60%. That allows the middle class to share in the growth in our overall equity markets and the growth of the US economy overall. Also, according to recent data from the Congressional Budget Office, median incomes for households aged 65 years of age or older actually increased by 38%, which I think is really significant. Further, according to OECD data, the median US retiree had the second highest disposable income in the world, second only to
Luxembourg.
Exactly. So I don't want to just paint a picture that everything is perfect. We know it's not, but we do want to make sure that we're providing a balanced view of what the system has done and where there is yet work to do, and there is work to do.
And for those of you listening to this, one key takeaway I think you should have is about the tendency for the negative view of the DC industry to separate DC plans from Social Security, right? The Social Security system was in place when DC plans were brought to market in 78, and the literal building of it was on top of the back of a very progressive system, which does make the isolated tax expenditure view by itself look interesting.
Yes.
But when you lay it on top of Social Security, which will give you some even more data here in a few minutes, it makes a lot more sense.
Yeah,
right?
our view is that you cannot separate those two programs. Those two programs have to exist as an ecosystem. It should be viewed that way. And when you view them together, the coverage, the benefits, the preparedness that most Americans have for retirement, the picture is very different.
A 90% replacement ratio. That's an amazing statistic.
We're in the ICI data.
All right, so we've talked a little bit about there's still opportunities for improvement, but some things have recently happened, right? So let's go back and talk about some of the provisions from Secure 2.0, all the state level activity that's been happening. What are your thoughts there? Is there anything that's already in motion that's starting to address some of these gaps? And what are your thoughts on how we should think about that?
So Secure 1.0, 2.0, two major pieces of legislation that were passed in recent years, 2019, I think in 2022 it was. And you typically don't see major pieces of retirement legislation in sort of 3-year spans like that. It's typically, people would say it's typically like the 7-year cycle. But in this case, 3 years apart. And I think in terms of where our research has picked up, differences and evolutions and benefits in the market is really more from Secure 1.0, because you've had a few years, now 5 years, to have seen how some of those provisions have worked. And a couple of provisions, one that made it easier to have sort of multi-employer plans with MEPs and PEPs. Another key feature, I think, from Secure 1.0 is the access for long-time part-time workers. And in the long-time part-time pool, you have a lot of diverse audiences that are part of that group. A lot of women, a lot of people of color. And so those provisions have made it easier for those individuals to earn the ability to get DC coverage, we think have made a difference. And just to cite a few numbers from our own research. So we analyzed data from the Census Bureau. This is a current population survey, and estimate that between 2021 and 2023, private sector retirement plan participation went up from 50.2% to 52.1%. Now, I know that doesn't sound like a lot, but we're talking about all the workers of the United States. That is a significant increase, and that means millions of people benefited. Now, I'm not going to say that those two provisions alone made all the difference, but that plus a lot of other things did help. And so when we go up on the Hill and we talk about some of the research that we found, Hill staff is very happy to hear it, because at the end of the day, they do want to see policy making a difference. And so when these facts were shared with them, they were really excited. The other thing I would add is with respect to that increase in our participation, we have seen significant increases in some of the diverse populations. So if we look at participation rates for Black workers, it went from 40.5% to 45%. That's a significant increase. Hispanic workers went up from 32 to 33%. And we've seen this participation across all income levels, across lower income levels within those populations, which is really significant. Now let's talk about state-run plans. So the state-run plans, just to give some context for what they are, in states that have passed this legislation, if you work at an entity, a company, in most cases, where you don't have access to a workplace retirement plan, you can opt into the state-run plan. And the state-run plans are they're run very inexpensively. They typically use very low-cost investment options. They're not subject to ERISA, but they're set up to enable and encourage individuals to start saving for retirement, because we find that once you get started, it just kind of feeds on itself. So these kinds of plans have been set up in at least 20 different states. And what we found is not only do you see the enrollment for those who were unenrolled before go up, you also see new plan creation happen in those states, which I think is one of the most significant takeaways. So this, I think, is another sort of key development in the marketplace that is encouraging more participation, which we know makes a tremendous difference.
So Michael, a couple of things I want to reiterate to make sure the audience heard. That 2 percentage point move on participation. Just think about it, for every 1 percentage point, you're talking about 2.5 million people. So a 2 percentage point move is likely 4 to 5 million workers that now have participation under their belt from a 401k plan that they didn't before.
Correct.
And that's in the last 4 years. I think that's
astounding.
The other thing that I would say, just anecdotally, having spent a lot of time in the field with folks like are on the phone here, that new plan formation, I know it wasn't the intent of the state level plans. It was to give them a safe place for workers to have this access that we all know, because of the payroll deduction element to it, is just, foundational to retirement savings. The new plan formation, I've talked to a lot of advisors that are in these concentrated places where the plans are. And it's a motivator for some small business owners to say, hey, look, if I've got to deal with the administration of connecting in the pipes to this state level plan, maybe I'll do that.
Yeah.
Or maybe I'll just go ahead and, start that plan up for my organization. So wink, wink, an opportunity for advisors to get out there, especially in those places where you'll see the headlines where growth is happening. And some of the incentives for participation in those state plans can sometimes be punitive, right? Yeah. There can be penalties for exactly not connecting in.
And they're all set up differently based on the state regulations that are approved. But I know some of the founders of these plans. I worked with them when I was in government. And at the end of the day, they just want to see more people covered. Yep. So whether you're covered through the state-run plan itself or it spurs additional plan creation, from their perspective, it's all positive.
Yep. Accomplished. All right. So this is a little bit of a leading question. Does the industry need to defend itself better or articulate its value proposition differently or more aggressively? I'm going to go out on a limb and say you probably think the answer to that is yes.
Well, no surprise answers, yes. But I would say, as I say to people, it's not about defending the industry. It's about defending the system that has made such a difference for so many people. At the end of the day, I know we're all invested in making sure that people can retire with dignity. And that's what you're defending, is their ability to do that. And so I think that we could do a better job of that. I know we at T. Rowe Price are going to be doing research that will be coming out in just a few weeks that really speaks to what has happened in the DC system, the improvements that it is embraced over the years, the impact it's had in the economy, all of that we will be talking about. And we know that there are other entities that have been doing that research as well. We just saw a great report from the American Enterprise Institute, but it's not the only one. So we will certainly be leveraging research. We will be spending time on the Hill to have those conversations. And then many industry groups and individual companies, entities have come together in the past when there have been these existential threats to the system. So in the budget bill back, I think that was sort of 2018, 2019, as people might recall, there was an effort to ratify the entire system, take away all the tax benefits for DC so they wouldn't be tax advantaged. And a lot of entities came together to combat that and were very successful. So, you know, if it comes up again, if it comes to that, I would anticipate we come together again. But I think for now, it's about doing the research, having the talking points, educating yourself, and making sure you're being conversant around those convictions in the marketplace.
And the partnership that we've seen, that I see in the field, dealing with organizations like yours and individuals like you, that coming together was inspirational, right? A lot of innovation has happened because of organizations like you that have driven prices down, driven coverage out. So I'm as excited as you are about that, Michael. One major criticism is on this whole kind of tax preference, right? How much of higher income brackets versus lower income brackets get those incentives? What's your reaction to people saying it skews more to the higher income earners?
Yeah, well, again, I would say you have to look at retirement as an ecosystem in the United States. And too many of these arguments and critics don't talk about Social Security. Again, it's got a very material role in the overall package of retirement delivery programs in the United States. So when you include it in the conversation, the whole outcome parameters change completely. So I'll just quote a couple of stats. So as we know, Social Security tends to replace a higher percentage of working wages for lower wage workers, right? And so I'm going to just quote. So if you look at Congressional Budget Office data from 2021, households in the bottom fifth of lifetime earnings distribution will receive Social Security benefits sufficient to replace 78% of the career average pre-retirement earnings adjusted for inflation. That is significant. Now, as you earn more, we know that the replacement rate you get from Social Security goes down, and you have to rely more on your own savings. So certainly it does provide a tremendous benefit for middle class. And what I say is, look, they're not saying anything about what the middle class should have, right? Because the middle class is not going to get that kind of 78% replacement rate for their wages. So what are they supposed to do, right? So let's not talk about pulling a system away that not only provides benefit for lower wage workers, but is, I would say, the workhorse for the middle class, right? So we would say it really plays an important role, but you got to think about the entirety of that ecosystem.
I do think one thing that comes to mind to me is some of that recent research we did that led to the 5D framework development, asks investors what it is that's top of mind for them as they're approaching retirement. And I think we often all fall victim to and see a lot of data that says they just don't want to run out of money before they leave the earth, right? Mm-hmm. But what we saw very loud and clear in that data, which I think is a testament to how the Social Security and DC system work together, is what a lot of people really want is to maintain the lifestyle they've become accustomed to, right? And so whether you make, $40,000 a year your last couple of years in the workforce, or $400,000 a year, trying to level out the pre and post-retirement income is ultimately the number one game for most of your clients, right? Most of your investors. And so I think laying it out as you did on the socioeconomic scale and showing the replacement ratios of income, to me, clearly articulates why, on a percentage basis, there's more being saved by those middle tiers of earners than the lower tier. They just need it. The gap is bigger.
Agreed.
Right? Yeah. Okay. On an optimistic note, we talked earlier about the 50th anniversary of ERISA. We're going to look back, we're going to look forward, right? So as you think about that, short-term, long-term, what opportunities are in front of you that you're most excited about that we can continue to improve the system?
Well, first of all, I continue to celebrate the fact that retirement tends to be very bipartisan. So when bills are introduced, they typically are introduced on a bipartisan basis. That continues in Congress. I'm excited about that. I'm also excited that as people think about improvement, again, they're thinking about it very thoughtfully. I'm thinking that doesn't make any sense, but I would say holistically in the way they're approaching it. And I think that in some respects is a model for other governments around the world. And we certainly have had conversations with other regulators in other parts of the world. I'm headed to Asia, actually, a lot of part of this year to visit with regulators in a lot of the Asian countries to see how they sort of march down this path. And they do really take a lot of learnings from what the experience has been in the United States. There are a few key provisions and sort of themes that we're looking at and following in Washington. So first, I'm sure a lot of folks on this call are familiar with the 403B efforts around the CIT efforts to have 403B plan assets be eligible to go into a CIT. We don't have enough time on this call to go into the history of that. Just suffice to say that a bill has passed the House and a bill has now been introduced in the Senate. We hope that bill will pass. That will give the security provisions passage that we need to have this whole thing work. And we hope that will pass. And so we're very strong advocates of that and have been involved in that effort from the very beginning. We also are happy that the system is looking at demographic retirement, retirement savings differences. And if you look at minority groups, if you look at women, you tend to see savings gaps relative to the majority population. With African Americans and with Hispanics, it's often around plan access. Many of them just don't have access to a plan. When they do have access to a plan, we find that in those plans, the savings gaps tend to be minimized between the various groups. With women, it tends to be a couple of things. They're not saving as much, and they tend to be more heavily loaded with debt. So things like, again, automatic enrollment, automatic escalation make a big difference. Also, efforts around like the student loan matching. It makes a big difference. And so we want to see those kinds of things continue. I'm also happy to see more conversation around things like personalization, retirement income. I think these are going to be dominant themes going forward in the marketplace as the country continues to age. And I would also say those are things that we see playing out not only in the US, but also around the world.
Couple of things I want to reaffirm what you said there, Michael. First, the whole notion of looking in beyond the averages from a participant standpoint and looking through whether it's demographic based or race or gender based and looking at those differences. Because I know for years and years, because of unintended consequences of the way ERISA was written, plan sponsors were often nervous to have any differentiated treatment among their participants. But again, I think we have a high confidence level now that if data drives you to say there's weaker or stronger participation or abilities of your employee population or your advisor client population to do that, we should absolutely look at that data and let it drive differences in communications, services, behavior, et cetera. And then I do think the other thing you mentioned about our short-term focus, one thing that I didn't hear you talk about is the notion of litigation reform, right? We have, I think, consciously worried about lawsuits becoming a little bit of a detriment to innovation because people are afraid to kind of be innovative and push their agenda there from what's not common. Any thoughts about helping try to rein in lawsuits just from a high level standpoint, what we're up to?
Well, I say we're at 1:30 and I just want to be attentive to time. Yep. I would just say quick that we're up on the hill. We're having a lot of conversations around litigation reform. Those conversations are going really well. And we hope that Congress will continue to think fondly of that effort because we do think the litigation's gotten out of hand.
Yeah, and you and your peers from an advisor standpoint, we do some research in the marketplace through our DC consultant study that clearly has shot up amongst the advisory community as a big concern is litigation in this space. All right, I think if there's no other comments to be made, I'll close it out for MD Squared here, Michael Davis and Michael Dozier at T. Rowe Price. We really appreciate your time today. Thank you.
Thank you so much.